Thanks for clicking. Canada's economy is starting to show signs of stress, with Canada's biggest banks preparing for a wave of loan defaults. Indeed, with Canada's banks putting aside $2.5 billion for loan loss provisions, and others saying that Canada is facing a margin call, a reckoning of sorts, the effects of 425 basis points worth of rate hikes over the past year are definitely starting to take their toll on the pocketbooks of Canadians.
Welcome to the show.
And with the increased cost of borrowing starting to work its way through the economy, the Conference Board of Canada is predicting a 94% chance of recession within the next 12 months. And given that a recession is very much what the Bank of Canada is trying to cause in an attempt to prevent a wage price spiral, the arrival of the pain that the bank has been trying to cause shows that Canada is very much moving in its desired direction. So what I want to do today is very briefly go over some of the loan loss provisions being implemented by Canada's biggest banks, take a look at some growing signs of a weakening economy throughout Canada, and then discuss what to look for next. Speaking of next, the Bank of Canada is set to make its rate decision on Wednesday, and Bank of Canada Deputy Governor Carolyn is also set to make a speech on Thursday. We'll obviously have an update out on both on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into the banks. On to the banks. Canada's biggest banks are seeing a major increase in the amount of risk in Canada's economy and have put away $2.5 billion in reserves for losses, a major increase compared to the $373 million that they'd put away just 1 year prior. And while $2.5 billion in loan loss reserves is a drop in the bucket compared to the $2 trillion in outstanding mortgage debt and $700 billion in outstanding consumer debt, it still represents a nearly eightfold increase since this point in time last year. With that said, Canada's biggest banks aren't expecting a major wave of defaults, nothing like we saw in the US in 2008.
We'll give it time.
However, they are expecting defaults to return to pre-pandemic levels. With the government taking away nearly all pandemic supports and the Bank of Canada raising rates by 425 basis points in the period of 12 months, personal and business insolvencies are all up in 2023. Indeed, a lot of Canadian businesses were being kept alive by those pandemic supports that we've had over the past few years. And now that those supports have been pulled back, we've seen a 55% increase in business insolvencies since this point in time last year. And it's not just businesses that are going insolvent from the removal of pandemic supports and the increase in interest rates. Bloomberg tells a story of a delivery driver who bought an ATV and leased a boat when interest rates were low, was subsequently offered a larger line of credit by his bank, which he then maxed out. Then, rates went up, the cost of servicing his debt exceeded his income, he filed for consumer protection, had his ATV repossessed, and is now on a very strict budget. And Bloomberg's report shows not only forced liquidations, but also anticipatory liquidations that we've talked about so much on this channel. A mortgage broker in Toronto reports having to sell 2 of his investment properties and is going to be listing a third after the rate hikes resulted in $4,000 in negative cash flow, stemming from higher mortgage payments. That same broker is cutting out Tim Hortons and has also canceled his cable.
I'm glad somebody's finally listening.
And although these two stories are anecdotal evidence of a slowing economy, we can see how the rate hikes are working their way through the economy. According to a new report from TransUnion, delinquencies are up over 10% across all credit products. Delinquencies, or late payments, on auto loans are up nearly 24%, lines of credit nearly 22%, and credit cards 17%. So, as we're seeing with the delivery driver and the mortgage broker, as the cost of borrowing increases over the past year, we're seeing Canadians increasingly unable to make payments on their debts. And when the cost of borrowing goes up, people are unable to make payments not only on their debts, but also unable to spend money in the economy, pulling money out of the economy, which will inevitably lead to job loss, which, make no mistake, is very much what the Bank of Canada is intending. With Bank of Canada Governor Tiff Macklem already saying publicly that our current unemployment rate is incompatible with a 2% target rate, and with the Parliamentary Budget Office already saying that it expects Canada's unemployment rate to rise to 5.8% this year, it's more likely than not that we're going to be seeing an increase in the number of defaults throughout 2023. So, Canada's big banks are preparing for a wave of defaults. We're starting to see the negative effects of 425 basis points worth of rate hikes over the past year, and it doesn't look like it's going to be getting any better anytime soon. And while we talked last week about Canadians who are continuing to spend, those were the Canadians that aren't leveraged. Those are the Canadians that don't have a whole ton of debt and have pent-up pandemic savings. However, as the data we looked at today shows, there is another side to this. There is a portion of Canadians who do have a lot of pent-up debt, who do have a lot of debt and are very greatly impacted by the increase in interest rates coming from the Bank of Canada. And although the data that we look today isn't very uplifting, it's not very comforting, make no mistake, this is very much what the Bank of Canada wanted to happen. This is part of the process of deleveraging. As the Bank of Canada raises interest rates, as it tries to get money out of the economy, these are the negative effects, but this is very much part of the process. This is part of the Bank of Canada's plan to get the money out of the economy, which will hopefully eventually bring down our inflation rate. Whether or not they will be successful remains to be seen, but we'll obviously continue to have updates out on their progress on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.